Hey, what's going on, guys? Now before I begin this video, I'd like to challenge each and every one of you to count how many times I say credit, credit score, FICO, or FICO credit score in this video. Let me know in the comments. Now that that's out of the way, let's begin. If you've ever applied for a home or auto loan, or even a credit card, then you know the importance of having a good FICO credit score. Lenders use this score to determine whether or not you're somebody that will repay their loan on time, if at all. When you have a low credit score, you're seen as a risky borrower and you'll have more trouble getting approved than somebody with a higher score. And while you still might be approved with a low score, you'll typically pay a higher interest rate, which could cost you thousands of dollars in the long run. If you don't know your credit score, you can go over to creditkarma.com for a free credit score check and credit report. Not only is Credit Karma free, but it also won't hurt your credit by checking your score there. In fact, being on top of your score will help you see areas that you can actually improve upon. The credit reports are generated by TransUnion and Equifax, which are two of the main credit bureaus. You can also get a free annual credit report at annualcreditreport.com, who partners with Equifax, Experian, and TransUnion to deliver your report. Links to these sites will be in the description. Now, after you've gotten your credit score, it's important to know where you stand and determine if it's a good score or not. The scores range from 300 all the way up to 850. There are many different ways to classify the scores, but they are generally broken into 5 different categories: poor, fair, good, very good, and exceptional. Anything under 580 gets you in the poor category. At this range, most lenders won't even give you a loan. The fair range is between 580 and 669. Here, it's still possible to get approved for credit, but it's likely that you won't get a good interest rate. The good category is considered between 670 and 739. In this range, you'll get approved for most loans and you'll get a decent interest rate. The very good range is from 740 to 799, and in this category, you're considered dependable and you'll get approved with a good rate. The exceptional range is anything over 800, and at this point, almost every lender would provide you with credit and give you the best rates possible. In this video, my goal is to help you improve your FICO score from whatever category you're currently in, all the way up to the exceptional category so that you can start getting better rates and save yourself both time and money. I'll be going over the 5 ways you can improve your score, starting with the least important and ending with the most important. So with that said, let's get started. The first way that you can improve your credit score is by limiting the number of times you get new credit in a short period of time. New credit has a 10% impact on your credit score. Opening new credit accounts in a short time period reflects greater risk to the lender, especially for people who don't really have a long credit history. Anytime you get extended new credit, there will be a hard inquiry reported by the lender which will negatively affect your score. This inquiry will remain on your credit report for up to 2 years, but will only affect your FICO score if it was from the last 12 months. The higher the number of new credit accounts you have, the lower your credit score will be. It should be noted, however, that your score will not be negatively affected if you're shopping around for credit, aka rate shopping. When you apply to many different places within a short time period, these will typically only be counted as one single inquiry. So while you're able to shop around multiple lenders to get the best rate possible, after you get the loan, you should probably wait at least 6 to 12 months before you start looking for new credit. In other words, if you just bought a new house, it's probably best that you wait off on buying that BMW you've had your eye on. And with that, let's move into the second way to improve your credit score. Although you shouldn't open lots of new accounts in a short time period, it is, however, important to have a variety of credit mix within your accounts, which has a 10% impact on your score. The reason for this is that lenders want to see that you've been able to handle different types of credit responsibly. This variety can include credit cards, mortgage loans, home equity lines of credit, auto loans, retail accounts, and also installment loans. To drive this point home, let's take Ben 1 and Ben 2. Ben 1 has an auto loan, 2 credit cards, and a mortgage loan. Ben 2 has 1 credit card and a student loan. Neither of them have ever had any late payments and both have used their credit responsibly. All else being equal, Ben 1 will have a higher credit score than Ben 2 simply because he has a bigger variety of credit accounts. So in order to maximize your credit score, you should have multiple credit accounts open, just make sure not to open all of them within a short time period. That brings us to the third biggest impact to your credit score, which is your average age of credit. Like fine wine, cheese, whiskey, Benjamin Button, and your 401k balance, your FICO score also gets better with age. The impact that average credit age has on your credit score is 15%. This is why it's so important to never close old credit accounts that you no longer use. The 3 main things that factor into this category are the age of your oldest account, the age of your newest account, and the average age of all of your accounts. This means that one of the best things you can do is to open a credit card right when you turn 18 years old so you can begin building your credit. Although it can be hard to get approved for credit when you're still young, there are a couple things you can do to overcome this. The first is to apply for a cash secured credit card. When you get a secured credit card, you provide the bank with a cash security deposit equal to the credit line. For example, Discover offers a cash secured card where you put down at least $200 as a security deposit and you get a card with a limit of at least $200. Link, you guessed it, in the description. By putting down a security deposit, the lender eliminates its risk of not being repaid as it can take the money from your security deposit if you fail to pay back any amounts drawn on the credit card. Once you show that you can use this credit card responsibly, your score should increase and you'll eventually be able to get approved on unsecured credit cards. Now, I hope you've been nice to your friends, family, neighbors, teammates, coaches, nannies, dogs, and strangers, because the second way you can overcome a lack of credit history requires you to have somebody that trusts you a lot, as you're going to ask this person to authorize you on one of their credit accounts. An alternative would be asking them if they'd be willing to be a co-applicant for a new credit account. Both of these methods work, and after using either of them, you'll be on your way to building a solid credit history. So remember, never close any old credit accounts, apply for your secured credit card if you need to start building credit, ask someone that trusts you to authorize you on their card, and of course, hit that like button and subscribe to the channel. So with that said, we now come to the second most important way to improve your credit score, and that is your utilization rate, which has a 30% impact on your credit score. Your utilization rate is simply the total balance of all your credit accounts divided by your total credit limits. For example, let's say you had 4 credit card accounts. The first had a balance of $500 with a credit limit of $4,000. The second had a balance with $300 and a credit limit of $1,000. The third had a balance of $400 with a credit limit of $3,000. And the last one had a balance of $200 with a credit limit of $2,000. You would have a total outstanding balance of $1,400 and a total credit limit of $10,000, which comes out to a utilization rate of 14%. A higher utilization rate shows lenders that you're overextending yourself and you're at a higher risk of default. A lower rate shows that you're using your credit responsibly. Ideally, you should always look to keep your utilization rate under 30%. Now, improving your utilization rate is actually pretty simple. You have 3 options. You can either ask for a credit limit increase, you can get a new credit card, or you can pay down your existing credit card balances. All of these will improve your rate and give you a higher credit score. Think about it, if you had a balance of $500 and a $2,000 limit and you increase the limit to $3,000, then you would automatically improve your utilization rate from 25% to 17%. In the same sense, you could just apply for a new credit card that has a $1,000 limit. You could also just have paid that $500 balance down to $200 and you would have improved your rate from 25% to 10%. Remember, just because you have a high credit limit doesn't mean you should even come close to drawing up to that full limit. Make sure you're using your credit cards responsibly by paying them off in full each month, and always keep your usage on them under 30% to maximize your credit score. That brings us to the most important part of improving your credit score, and that's your payment history, which has a 35% impact on your credit score. So I currently work as a credit analyst for a bank, and I pull a lot of credit reports, and I can tell you firsthand that there is a huge correlation between late payments and a bad credit score. You want to do everything that you can to avoid making a late payment on a loan. And that might mean drawing up a credit card temporarily, asking your friends and family for help, crafting a handwritten note to the lender, opening up a lemonade stand for the weekend. You get the idea. Now, of all the credit reports that I've looked at, a late payment only shows up when it has been more than 30 days late, so you'll typically have a 30-day grace period on most loans before it's considered a late payment. You'll also get additional marks at both the 60 and 90 days past due mark. As you would imagine, the longer the late payment, the bigger effect on your credit score. It's also worth noting the bigger the loan you missed a payment on, the bigger the negative impact on your FICO score. It's crucial that you don't let any accounts go into collections, which typically happens after about 180 days of not paying your debt. Even after paying these collection accounts off, they tend to stay in your credit report for a long time and they'll hurt your credit score a lot. Other things that negatively impact your credit score include bankruptcies, lawsuits, and tax liens. These are much more serious than late payments and will usually stay in your credit report for at least 7 years. Now, if you do end up getting a late payment, try your best not to panic and realize that it's not the end of the world, just your perfect credit score. Continue on like you normally would, use the methods that I outlined in this video, and you'll be on your way to a respectable credit score in no time. So overall, I hope this video helped you realize that you don't necessarily need the Rosetta Stone to interpret your FICO score. When you break it down, it's actually pretty simple, and once you know what lenders and credit bureaus look for, you can take the necessary steps to make sure you're optimizing your score. To give you a little recap, make sure you never miss a payment, keep your utilization rate lower than 30%, keep your average age of credit high by not closing old accounts, keep a variety of different credit accounts, and lastly, don't open up a bunch of new accounts within a short time period. Now, as I mentioned at the beginning of this video, I highly recommend going over to creditkarma.com to get your free credit score check and credit report. You could also head over to annualcreditreport.com, who, as you would imagine, will give you a free annual credit report. Your credit score won't be negatively impacted by doing this, and you'll be able to look at your FICO score directly in the eyes and come up with a game plan to improve it. Links to these sites can be found in the description. Another thing that I highly recommend is hitting that like button and subscribing to the channel so that you're notified each and every time I upload a new video. If you have not already, I would also highly recommend watching my previous video on easy ways you can manage your money. I'll be sure to leave a link to that video in the description. I hope you learned something from this video. Thank you guys so much for watching, and I'll see you in the next video.